We're going to start the next session, session 15, Trade, Credit Insurance and Surety Bonds, two powerful financial tools to increase business profitability and sales growth. Moderator, François Masquelier, the chair of the EACT, and panelist, Theresa Skarlatou, the CEO of Allianz Trade in Greece, and Philippe Neighorn, Managing Director, European Surety Leader and Global Accounting Leader from Marsh. I would like to welcome them on the stage and please give them a warm round of applause.
Let's start. Good afternoon. Thanks to HAT for inviting me to come to attend to this conference for the fourth time and to moderate this session. So I'm pleased to welcome Theresa and Philippe. So welcome. Two experts in the topic we will address. So the topic we want to address today is the trade credit insurance and the surety bond. That could be two powerful financial tools to increase the business profitability and sales growth. Actually, I'm traveling a lot, attending a lot of conferences, and I have to confess that these two topics are never addressed or very seldom. So I think it's a good opportunity to explain, and I'm sure Philippe and Theresa will start by explaining what these two products are. And it's an interesting issue because we saw this morning that the economic situation is not that fantastic. We have some, let's say, uncertainties for 2025. So we know that counterparty risk is coming back. We saw that in spring 2023 with banks, but we have also some, let's say, risk with our counterparties, we are customers. So it's interesting to see in which case a corporate treasury could give some value and generate value for the operation. And so we'll see with these two products that are a way to mitigate your risk, but also to have alternative ways of mitigating risk. And I count on you to give us all the insight and the takeaways about these two products. So maybe let's start with a very quick introduction to explain who you are, your role, and what is your company. Maybe let's start, ladies first, by Theresa. Please.
Thank you, François. First of all, let me say I'm very happy to be with you all here today. It's a wonderful opportunity to exchange with you all. I am Theresa Skarlatou, as you said. I'm the CEO of Allianz Trade here in Greece, responsible for Greece and Cyprus. I think you all know Allianz, and of course, together with Allianz, you know Allianz Trade. Allianz Trade does credit insurance, surety, and other things, offers other similar products. However, Allianz Trade is the leader, the global leader in credit insurance, an expert in surety, and we are proud to say, to mention some numbers, that every year Allianz Trade offers globally more than 100 billion in surety guarantees and insures more than 1 trillion of commercial transactions worldwide with TCI, with credit insurance. So you understand the importance Allianz Trade plays in the global economy in this field, TCI and surety.
Interesting figures. And with you, Philippe.
Yes, and thank you, François, for moderating. It's my privilege to share the stage today with Theresa and to be invited to attend this event for my first time. So thank you. For those of you who are not familiar with Marsh, we are part of Marsh & McLennan, a global firm. Marsh is the risk and insurance advisor and global insurance broker, the largest one in the world. We also have the largest surety team globally, 300 surety colleagues. We're part of the credit specialties group within Marsh. So we focus on trade credit, political risk, structured credit, and of course surety. So all the credit products are within one group, and that's a really special, we think, arrangement for us and allows us to serve clients well. I've been with Marsh for 19 years. I've been doing surety for 27 years. Spent 5 years based in Amsterdam, but I currently split my time between Dallas and Madrid. So I get to see a lot and hopefully bringing a bit of a global perspective to this discussion today. Also, it's also my honor to represent our local team who are fantastic here in Athens.
Okay, so you can see that we have two experts in their field. So maybe I do propose to start with the first product, the surety bonds or surety guarantee, and then to continue with the trade credit insurance.
Yes.
So let's start with you, Philippe. So maybe first question, why do clients utilize surety bonds in lieu of the or classic bank guarantees or standby LCs?
Yes.
What is the reason?
Great question. You know, for those corporate treasurers in the room, you know well that oftentimes you're asked to provide third-party guarantees, bank guarantees, standby letters of credit. Those facilitate your operations. You can think of surety guarantees as being basically substitutes, but I would say a complementary product for bank guarantees and standby letters of credit. Again, you're often required to put up these third-party guarantees for customers of yours, counterparties, sometimes regulatory agencies, and surety is just an alternative way to satisfy these requirements. In terms of why our corporate clients choose to use a surety guarantee sometimes instead of a bank guarantee, it's really driven by liquidity. It's driven by having access to additional sources of capital, creating more working capital, more headroom under your bank lines. And that's, as we've heard many times today, I think a critical piece of the puzzle for treasurers. There can be some other motivations also. Sometimes it's around maybe capabilities of issuance in certain geographies. Maybe it's different appetites between the markets. Oftentimes there can be cost savings, between or cost differences between banks and sureties just because of the way that the capital is allocated. But a lot of times what we end up seeing are banks hit limits sometimes with their corporates, and this is a way to also allow the insurance market to satisfy those guarantee needs that the banks may have normally done. And from a beneficiary standpoint, they like having the mixed economy, basically of guarantees coming from banks and from highly rated insurers that oftentimes have A+ ratings or better.
No, it's a fair point because in Europe we highly depend on, let's say, bank funding.
Correct.
And so we could have limited capacities. So a way to mitigate the risk is to diversify, but also diversifying the source of guarantee. It's a way to mitigate your risk or to keep headroom for real credit and borrowing in case you need. But please, could you describe how surety guarantees work and who issue them?
Absolutely. And again, you can think of them as basically substitutes for bank guarantees, letters of credit. They are issued by insurance companies. The companies that we work with, such as Allianz Trade, have a specific practice within their group. We go to them to arrange for these guarantees. They're issued on behalf of the corporate in favor of a beneficiary, as we've described. They can be, the underlying obligation could be one of performance or it can be one of payment. I think it's important to say that not all insurers will write all the different sort of payment guarantees, but many payment guarantees or even financial guarantees are in scope and are ones that they will support for the right names. Nobody's allowed to issue guarantees that guarantee the repayment of a loan, but other sorts of payment guarantees are definitely in scope. As you can see from the chart here, you can see that ultimately the corporate always maintains the ultimate responsibility. The only time the surety bond really comes into play is if there were to be a default. That would generally come because of liquidity issues or insolvency, and the surety is there to make sure the beneficiary is made whole. There is an indemnification agreement, and that you can think of that as the recourse document, and similar to your bank facility agreement, where the surety would then be permitted to pursue reimbursement from the corporate should they default. But the way that surety works is you never expect to have a loss. You underwrite it to a zero loss ratio, but as we know, things happen.
You mentioned documentation. It's rather reasonable in terms of documentation, the way to
It is. Generally, surety lines are unsecured. So you're making a promise to reimburse, you're making a promise, right, to pay. There's certain other requirements in terms of financial information and things of that nature. Again, depending on the situation, the sureties might want to have the benefit of maybe covenants you have in your bank guarantee, or bank facilities and things of that nature. So there are some nuances in there. Each negotiation is slightly different, but fundamentally, again, it's such a successful product because our corporates don't have an issue signing on to these facility agreements because they're oftentimes maybe even a little easier than the bank documents.
Okay, good to know. So, and what industry sectors are utilizing this kind of guarantee? Is there specific sector where a surety guarantee could be more important? What sort of applications for these guarantees?
No, great. My short answer is all of them, all sectors,
All sectors.
all companies. I would argue that virtually every company in every geography will have some sort of a need. The biggest users of surety capacity and surety facilities are those that are in sort of the project space. And those, of course, would be contractors, infrastructure firms, things of that nature. But it also includes maybe a telecommunications firm doing a 5G network project or things like that. So anything that's project related, there's some very fundamental guarantees that are needed. It starts with the bid process. Sometimes you have to put a guarantee in when you're bidding, but when there's a project award, there's a performance guarantee that guarantees successful completion of the project. There's an advance payment bond, which is really a liquidity enhancer, and that advances funds to the contractor from the beneficiary and project owner. And then when you complete the project, there may be some warranty or maintenance guarantees that are needed post-completion, just to make sure, again, that the beneficiary gets what they paid for. When you step outside of that, again, those that can be used in the energy space and manufacturing, and there's all sorts of applications. When you get beyond sort of that project list, you get into energy and power. And there again, you've got some of those applications, but you have others. We do things that guarantee or guarantees that will ensure the delivery of commodities, whether it's crude oil, gas, power and electricity. You know, renewable energy is, of course, a huge area of focus for us and in a big driver of our growth. Power purchase agreements, grid connection bonds, when you're putting in these renewable energy projects, that's something that we've seen a lot of activity in. And I would say there's other sorts of transportation guarantees. And then there's the industry agnostic. So when I said that virtually every industry has a guarantee need, that would include things like payment guarantees, the permitted ones, payment of taxes, customs guarantees, sometimes lease guarantees, things of that nature. Sometimes our corporates find themselves in a situation where they're appealing a fine, a judgment, maybe they don't agree with the taxes that have been assessed, and there's a process for appealing. You can put a surety guarantee in place that basically is a placeholder while you go through that process. You're not tying up your bank lines or cash during that time. And then finally, there's things like insurance guarantees. If you have a fronted insurance program, there's guarantees that make sure employees are protected in the event of an insolvency. So there's almost an infinite applications.
So sector agnostic, but you mean projects, so with a certain terms or let's say time to be delivered. And so does it take long to get an approval, because you need to analyze your risk?
Yeah, and I think that really leads into sort of the process, right, and how things work with the surety. So yes, what you want to start early, like anything. You don't want to go to ask for a guarantee the day you need it. There should be work that's been done ahead of time. Yes.
Ask for credit.
Right. But the turnaround times are short once you have that established.
Okay, great. And what factors are influencing the insurer's appetite for and capacity or pricing for such products?
It really, I think of it as a credit story, and then you have a guarantee analysis, and then if it is project work, an analysis of the capabilities, right? So those are the three main things. In short, you can think about it the way when you go to build a facility with the bank. They're analyzing the same things from a credit standpoint: the balance sheet, the P&L, what your future outlook looks like, the equity base, debt service, those sorts of things. So very credit focused. That's the first gate. Once they say, this is interesting for us, we like the credit story and the go forward look, then you start looking at things like, is it a payment bond, performance bond? Is it something that's needed for 6 months or 6 years? Is it conditional or unconditional? Because we write both in the surety world. What's the prevailing law or the applicable law? Is it something they're comfortable with and they feel like they'll be treated fairly from a legal standpoint? And then what's their response period? What happens should there be a claim? Can they adhere to the requirements there? So those are all things that they will look at. And then again, on a project basis, if you're building a bridge or a tunnel or something like that, they want to make sure you've done it before and you're capable of doing it. And what I typically say is everything on the left on this chart will influence everything on the right. How much interest they have, what capacity, what sort of limits, pricing, indemnity provisions, how tough they'll negotiate on indemnity, what provisions they may need there, and ultimately if there's any collateral or security. As I said, typically these are unsecured facilities, but sometimes there's some collateral or security used to help enhance.
And maybe to finish a double question, but as we are in Athens, so what about the perception of the Greek market by the international insurer? What is the perception? We heard this morning, and last year we have been, let's say, facing the increase of the rating of the country. So, do you see that is an interesting market, and ought to attract more, let's say, insurer into this market for such products?
Absolutely. No, I think, well, first of all, we think of the Greek market as three things. Greek company that needs bonds here. We think about it as Greek companies doing business outside of Greece that need support there as well. And then also companies or corporates that are based outside of Greece that are doing business here and need guarantees. So all three of those are in scope for us and things that we look at. You're exactly right. I think the sentiment and the outlook for Greece is turned very positive. The upgrade certainly helped, so congratulations on that. But I think the political stability, the infrastructure spending, there's a lot of positive. So I would say if you're looking again at what the sureties are looking at from an analysis standpoint, Greece is an area that's on the upswing, and I think that will attract more capital and more interest. Some of the things that are unknown, and we had this discussion with a client yesterday, there's not a negative story when it comes to how cases are handled in the event there's an insolvency and a claim, and it's just, I would say it's a bit unknown for some of the other markets. Again, we've got some great partners that have been here for a number of years and are doing a fantastic job of supporting guarantees here in Greece. But I think we could all agree that we want Greece to be a fully developed surety market like we see in the UK, Northern Europe, Western Europe, and that will again attract additional optionality for our clients. But I'm optimistic, and that's why I'm here.
It's room for improvement and increase. So
Yeah.
Thanks a lot. So let's move to the second topic, second product. Although Allianz, Theresa, is doing both, if I'm understanding well. So let's talk about the trade credit insurance. And so the first question, Theresa, so what is trade credit insurance? Because I'm not sure that everyone knows that, and how can it be integrated effectively into your, let's say, company risk management strategy?
I'm trying to move.
Could we move to the?
Yeah.
Yes, thank you.
There we
Now
go.
it's done. Now it's done. Yes, thank you, François. Indeed, I'm going to speak about credit insurance, since Philippe has explained so nicely the product of Surety. Just let me add that indeed Surety grows very, very quickly now in Greece. Indeed, the growth is exponential. So, credit insurance, again, is a powerful risk management tool that is designed to protect businesses from losses deriving from non-payment by some of their customers. Credit insurance is covering the sale of goods and the provision of services on credit. For B2B sector, credit insurance is crucial because most of the transactions are held on credit. And sometimes we see credit terms being extended, which means more risk for the company that sells the products or provides the services. So, credit insurance really protects the cash flow of the companies in the event of non-payment by one or more customers of the company and provides financial stability that otherwise could be jeopardized. How it works? Well, in a few words, at first, the credit insurance policy is underwritten and signed and adjusted to the specific needs of each business. This is important to say because there are no two equal and identical policies in credit insurance. The tool is providing for a diversified solution for every company. Every company has its own tailor-made credit insurance contract. So the policy is issued, it is signed, and immediately the credit insurer, Allianz Trade, in our case, underwrites, assesses the risk of every individual customer of the company, of the policyholder, and assign specific credit limits for them according to the wishes and needs to the company, but according as well to the credit worthiness of each customer, which means we underwrite almost the full clientele. We leave aside only the very small customers of the company, of the policyholder, and we underwrite the majority of the clientele in order to provide specific credit limits for which we are then responsible. In case of a non-payment, we need to pay instead of this defaulted customer. We immediately undertake as well a constant monitoring of each customer of the policyholder, which means we don't stop by giving the initial credit limit to the company, but we continue with risk monitoring, with evaluation of the financial condition of each customer, and then we update, we review accordingly the credit limits granted. In that way, providing to our customer updated information, always fresh, always new, we help them take well-informed decisions in order for them to grow more safely. So in reality, we boost their growth, we boost their sales in that way. So if the event of non-payment happens, of course, we indemnify our customer, and then immediately after we undertake debt collection procedures, which means we can start by negotiating the debt, or when needed, we go legal. We proceed to legal actions. In a nutshell, these three pillars, these three services of credit insurance are prevention and protection, indemnification in case of bad debt, of non-payment, and debt collection. We always speak about these three services provided through a credit insurance company.
Like for classic insurance, the price could evolve, the premium could evolve over time?
The price is not...
Because you onboard new customers, so situation could evolve, or...
Yes, the price is not standard. It's also adapted to the specific risk profile of each company. So there is no one price to mention in reality.
So what role does the credit insurance play in navigating these complexities of the global trade, and particularly with this current, let's say, difficult economic context we are facing? So, I mean, internationally, because we know the domestic insurance, but when we go abroad, you have more uncertainties, I guess.
Indeed, in today's dynamic but also interconnected global economy, we see that business can face many challenges deriving from economic volatility and going to instability in the geopolitical instability, let's say. We have seen this happening during the last years, unfortunately, even during the last months and weeks, I would say.
Disruption in the supply chain.
Yeah, this is the new rule. This is the new reality we need to face, and in this context, businesses need to grow and to grow safely. So, indeed, again, you can see here some numbers. One of them I mentioned earlier. We have, as a credit insurer, to put in place in order to protect our customers, a very robust credit intelligence framework in order to underwrite what is happening all over the globe. We at Allianz Trade, we have in place this credit intelligence framework. We have our own proprietary database with information about 83 million companies, as you can see, all over the globe. Information always kept updated by local network operating, again, all over the globe.
So on top of insuring the customer, you try to give them some pieces of advice in terms of countries, sectors. Okay.
Exactly. We underwrite country risk. We underwrite country risk in 240 countries all over the world. We underwrite sector risk. And finally, of course, we assess and underwrite risk of every individual company.
So it could be indicators that some areas or sector could be risky and
yes,
better not to...
Through all this information, we are able, yes, to help the companies navigate all these risky areas.
More than a product advisory. So, but what role could the credit insurance play in empowering business? Because we talk about creating value with your two products and to explore new market opportunities. So could we in Treasury, by using your products, give them opportunities to explore new products and maybe to develop sales volume? Because we are all looking for maintaining our turnover. So, and where for once, or some other example, Treasury could bring value to the operations.
Yes, indeed. Well, first of all, expanding into new markets, expanding to new customers, even expanding sales to already existing customers, and even changing or expanding credit terms to existing customers or new customers is very important to the businesses. Giving better terms to a customer immediately differentiates the business towards their
competitive advantage. Yeah.
Yes. So this helps a lot when it comes to new and more sales. And to more profitability. So in reality, credit insurance provides this safety net and this guidance and guidelines for the businesses to be able to expand safely, to trade with confidence without the fear of unexpected risks or expected risks, because statistically, I mean, non-payment, a non-payment will come.
Occurs from time to time.
Normally, it happens. So this is the biggest value of credit insurance, that it allows the businesses to grow with confidence, safely, with no unexpected bad effects on their profitability, on their stability.
Okay, I think it's time to welcome questions. I don't know if we have questions on the, let's say, we have some questions. So do you have specific sector or geographies, minimum portfolio threshold below which you do not issue instrument? So is there some, let's say, threshold or up or down limit, minimum, a cap or floors? Are you excluding some sectors and geographies? So interesting question.
No, by definition, no. We don't exclude. On the contrary, we try to offer the product for all sectors, all geographies. And to speak about the size, we try to have also products for very small companies. We start from very, very small companies with what we call micro SME products, and then we continue to companies, to mid-sized companies, up to companies with millions and millions of turnover.
But are you modulating the premium, because the business could shift from geographies or sectors depending on the business, depending on the situation, depending on currency we talked about earlier on? So are you adapting your premium to the, let's say, evolution of the business of your customers?
The premium is adapted to the risk profile of the company, of the country, of the sector.
So it's evolving.
It's evolving. Generally speaking, credit insurance is much more affordable nowadays than it used to be some years ago. This also goes with the fact that is quite generalized nowadays. Some decades before, it was seen like a more exotic product. People thought that it was expensive or it was a luxury product. Only big enterprises could afford, but this is not the case anymore.
And of course, I forgot to ask, but I guess when you have compliance, prohibition with some countries, some sectors, some products, you are following the
sanctions and things of that nature
imposed by the different government
Absolutely.
or
Off limits,
supranational.
yeah.
Absolutely.
It's quite an issue these days.
And then there's some other countries where just the political situation, or again, what I was saying about unfair calling of bonds and a politicalized court, whether you're going to get a fair hearing or not, those come into play also.
So it comes to the second question, so I don't know if I understand well, but it means that could you, with this valuable data you collect because of your business, and you, let's say, global view, offer this kind of services, if I understand well, more than insuring, it's more advising. So is it coming with the insurance, or are you also giving some advice to?
We offer this knowledge, this intelligence, together with our product. So we offer information and prevention, protection, together with indemnification and debt collection, as I said before. Yeah.
And
Okay.
I'd say from a surety standpoint, we also collect quite a bit of data. We do share that with clients, rate benchmarking and trends and things of that nature. In a partnership with our sureties, we might provide a specific view into what's happening in a certain particular geography or sector also. We don't do that externally. We don't sell that data, but for clients, we try and package that in a way that helps their business.
Small service for your customers.
Correct.
But speaking about the cost, François, we can also mention that for companies having in place a credit insurance policy, it is much more easy to get financed by financial institutions, and the terms, the financing terms,
of course, could be
are always
much better.
much better, because they are considered to be financially stable themselves when they have in place such a contract.
And I guess this morning we were talking about AI. But I guess that with AI, you will certainly have also better anticipation on the potential future risk of your
powerful tool.
Customer. I think it's time to close the session. So sorry we have been long, but it was interesting question to address. Thanks a lot. I hope it was interesting, and our panelists are there.
Thank you.
For any additional questions.
Thank you very much.
Thank you.